Hello everyone, Dr. Stock, Doctor of Education. The PPI came out today and man, oh man, was it another hot read, just like the CPI was another hot read. We need to take a look and see what that came in at and how it compared to consensus, and what did the Fed do about it? Did they come out and say, we expected this? Or did they come out and say, we need to do more than what we're currently doing? That's what we're going to talk about in this video. So make sure that you stick around, watch it, listen to what I have to say. If you want to hear more of my commentary, please check out the link for the Patreon down in the description with all the other links that are down there too. I'd absolutely love to have you over there as part of my community, and thank you ahead of time for supporting the channel. I look forward to seeing you over there. Let's move on from that and get right into it. So the PPI came in today at 0.7 month over month compared with consensus of 0.4 month over month. So we came in almost double of what consensus was for PPI. And that's the producer prices index. So rising prices for the producer could possibly mean rising prices for the consumer if the producers have pricing power in order to pass that along. If not, that means that it's going to eat into the margin, into the bottom line of the producers. So that causes a bit of an issue. That is something that over time could slow down the economy. And while that will eventually bring inflation down, however, the Fed is doing whatever they can to bring that inflation down. So right now, the Fed came out at about 3 o'clock today and said that they need to do more to see this through. So there's that possibility that in March, instead of seeing a 25 basis point hike, that we see a 50 basis point hike. And that is yesterday in my video when I said that, things were looking kind of bullish. Then we get this PPI report come out, and then the Fed says, not 25, maybe we need to entertain the idea of doing a 50 basis point hike. So 0.5 instead of 2.25%. That is troublesome for the markets because that's the Fed being a whole lot more aggressive. And that's something that is rattlesome to the markets that causes it to drop very quickly. And I actually have that here on the screen for you. The stocks drop after hawkish talk from Fed. And I don't know if I could say that again. That seemed almost like a tongue twister. I feel like I said the name Tom in there somewhere. So these stocks drop, and I believe I have a graph. Here we go. This one says what to watch today, and it was kind of a neat day, and then 3 o'clock comes along. Right there's 3 p.m. and all the markets were doing fine all along, and then poof, they just dropped off a cliff. And as of right now, it is 4:07, so the markets have closed. So let me just take a quick look, and we'll see where those markets closed. So the market having closed since I started recording this video, the Dow down about 1.25%, the S&P down about 1.33%, and the Nasdaq down about 1.75%. Just absolutely falling off a cliff from where we were at, that sort of euphoria that we were feeling where it's like, whoa, hang on a minute here. Maybe this is that time that we start to see that retracement. This is the sort of moment that makes it vitally important to watch economic reports as they come out and try and look ahead to see ahead of the game what to expect for the markets. And in doing so, when we look at consumer debt or household debt, and we got that report today that's outside the scope of this video, but I do just want to share it. Debt's not looking so great. Debt is moving up. And the big thing there is that student loans haven't even started yet. So once they restart, and the most sensitive demographic that we have in household debt, by the way, 20 to 29, followed by 30 to 39, followed to 40 to 49. And guess who most likely has a lot of that student loan debt? And also guess who hasn't even started paying on some of that student loan debt? As soon as the moratorium ends, they're going to be hit with student loan debt like they've never experienced before. This could be very dangerous for that 20 to 29 demographic. And also just keep in mind that the delinquency lags lifestyle, that people will not be delinquent on their payments. And that's really, we see a really big jump right now in consumer debt is with that 90 plus days delinquent. And I will share that with you in another video. I don't want to get too far off topic here, but I do want to point out just how quickly the market changed when the Fed comes out and talks about a higher rate hike than was expected. We were expecting 25 basis points in March, 25 basis points. June, I think, was the next one to come out, and then 25 possibly in July, or even possibly pausing in July. So not only could this raise it for March, there's talk of that from the Fed, but it could also mean still further rate hikes to go afterwards. So we don't know if they'll actually do it or not. There's no promise for that. But the idea that it could happen, that emotion, remember, is the thing that causes the market to move so quickly. So emotions play a huge role of this, and that fear that something bad is going to happen drop the markets like a rock. Whenever we have that euphoric feeling that things are going to go very, very good for the markets, that's what's going to move them up. So let's take a look at the charts for this. So what we're looking at on the chart is the SPY, which tracks the S&P 500. And I would just like to point out this orange dotted line that you see where the day closed at 408. We are sitting right at some very firm support. That doesn't mean that we won't drop through it. Tomorrow is a Friday before a 3-day weekend, so we could see a lot of volatility in the markets, and if this fear doesn't subside by then, it could be another red day and we fall down through this support, possibly coming down to this 50-day, which is sitting down. Let's bring the crosshairs up here. So 396. That'd be a 3% day. Ooh, I don't know that we come down that low. I think honestly, maybe we come down to about here where we have a little bit more minor support right around that $400 range, maybe 4,000 in the S&P, which today closed at 4090. So honestly, at the worst, I think we get a 2% drop tomorrow. That doesn't mean that we do that. And having all the options activity that we're likely to have, because you don't want to hold options over a long weekend, because the time value will still keep on eating away at any sort of profit that you have. So there'd be a lot of activity most likely in the options market. So while that means volatility, it doesn't necessarily mean up or down. How we close the markets today could mean, maybe we close down below this area of support prior to the long weekend. We're going to have to watch and see. So let me grab this tool because I think this is really nice for doing the videos, that it actually shows what I'm looking at. So up to the top, this previous peak that we have about 2% up, and down to this other area of support down here around 400 is about 2% down. So we literally have support up and down 2%. So that's my delta, I should say, my expectation for tomorrow if we have a big move in the SPY. And I think 2% is a bit much, but hey, if this news is received worse than I think, maybe we come down as far as the 50-day, which is that 3% drop, which would be an enormous drop in the S&P all in a single day. That's usually safe for some really bad news. So not that the 0.5 basis point is, not the 0.5% or 50 basis point hike is good news, or not that it's only just a little bit bad, because honestly, I think that they've done enough with their quantitative tightening. I think they need to let things run their course at this point in time. The Fed is saying that they don't think that that's the case, or maybe they're just putting out more talk, more rhetoric, more scare tactics in order to make that happen. There is power in some threats because, well, they have enforced them. So what's to say that they wouldn't enforce them again? We're going to raise the federal funds rate by 1,000 basis points or 10%. Those would be scare tactics that it would never be delivered on. Nobody would believe it. But that 0.5, especially with the reports that we're getting, if March leading up to that next FOMC meeting is the same sort of thing that we're getting now, that could really solidify that 50 basis point hike that they're talking about. So it could be a real danger. And so that believable amount of fear of a 50 basis point hike is enough to cause the markets to drop like they do, or like it has. So let me just go intraday real quick. So taking a quick look at the intraday, you can see the sort of drop that we experienced. If we go back here to 7:30, and there's 8:30, here's where the PPI report came out, and it came in hot, 0.7 month over month for final demand, and for core, it came in at 0.5. The consensus for core was 0.3. We came in at 0.5, so 2/3 higher. And the consensus for final demand was 0.4%, and we came in at 0.7% month over month. So 3/4 higher than what we were expecting, than consensus. And well, the market didn't react very well to that at all. However, market rallied anyway. And then 3 o'clock came and Fed's like, you know what, 50 basis points, we might have to do it, and drop like a rock. So that's the power the Fed has, just through talking. They didn't even take the action yet, just through talking. And the market comes right back down. Now, I do also like to look at the Qs. So tracking the NASDAQ 100, you can see the same drop early on in the market, same drop right at about 3 o'clock. This is the half-hour chart. So the 30-minute chart, so this candle started at 3 p.m., which is Eastern Standard Time, closed at 3:30. So here we're looking at the daily chart for the Qs, and you can see any sort of progress that we had came crashing right back down on us. Now, as far as dropping from where we're at, let's see what we have, because we don't actually have any clear tops on here that we're currently sitting at, any previous peaks that were formerly resistance that now can be treated as support. So let's come off the bottom here, find out where that takes us. So for the NASDAQ being a little bit more reactive than what we'd have for the SPY, probably 2.5%, I would say, would be a really big move for this. If I said 2% for the SPY at the worst for downward movement and 2% up for the best movement that we would see, we'll see what sort of volatility we get tomorrow if we were finished dropping down from where we're at as the market digests the news coming from the Fed, or if we'll move back up and retest some of these other highs where we stalled out before at about 2%, or really, really positive news at 3.5%. That seems unlikely. I think we might come back if we, for some reason, have a really strong day. It looks like maybe 2% up in the NASDAQ in the Qs that we have here to possibly 2.5% down. And I would say that would be, in light of current information, the most that we would see up or down in the market tomorrow. So I would keep an eye on that. If I had to say for tomorrow, I'd say within 2% either way for the S&P or for the NASDAQ. And if I had to pick a direction for tomorrow, I think that we might see a little bit of further weakness going into the long weekend, especially with people closing out positions, any sort of gains that they had from the week, if they haven't done so already, tomorrow. And then on Tuesday, people setting up their new positions and picking up for the new week ahead. And next week, we have the Fed minutes to look at, and that could give us more information from their last FOMC meeting, and we could compare it to what we're currently seeing in the markets and make a decision for that going forward, making our best guesses that we can towards the summary of economic projections that comes out following their FOMC meeting at the end of March. I believe it's March 22nd and March 23rd. I keep on forgetting that date. It's either 21st and 22nd or 22nd and 23rd. I'll have to pull up the calendar again, take a look at that, and get back to everyone. So that's what I have for you guys today. If you enjoyed my commentary, please hit the like button and let me know. Hit the subscribe button and the notification bell so that you can see anytime my videos come out. Down in the comments, let me hear from you. What are your thoughts on the current market, on the FOMC, rate hikes, inflation, or maybe even just to say hello? I'd absolutely love to hear from you. And if you want to hear more of my commentary and access more of my services, there is the link for the Patreon down in the description. You'll also find other ways there that you can help support this channel. I really appreciate you guys watching the video for this long. And thank you for allowing me the opportunity to have some of your time. I really appreciate it. I'm Dr. Stock, Doctor of Education. We'll see you in the next video.